Money on my mind, looking for a dime. James Lock in the house, gonna help you shine.
Welcome to the Pool Lock YouTube channel. I'm James Lock. Today we're going to answer some of the Ask James questions of the day. This first question is from Paul. We're in the last couple of years before retirement, and we're trying to load up our 401ks. Is that really the best strategy? All right, Paul. Well, the answer is it depends, because if you have balance between kind of the three kinds of accounts I've talked about before, right? If you have money in taxable accounts, tax-free accounts, and some money in tax-deferred accounts, right? And you're in a high tax bracket right now, maybe that's the best strategy. Because if you're in a high enough tax bracket and you want to max it out, max that kind of $31,000 a year out, it may only decrease your take-home pay by $18,000 or $20,000. So think about it. You're decreasing your take-home pay by 18 or 20, but you've got $31,000 going into the plan, going to work for you. That's some pretty good leverage. However, what if you're lopsided toward the plan? If you're like most, you've kind of maxed it out, you've done everything. Maybe your kids are out of college, so you don't have any 529 money. Maybe you got a little bit of Roth IRA, but that's about it. Now you might have the problem that I often, subscribe that people end up having, Paul, where, you're retired, you're going to buy a car, and guess what happens? You have to pull out a lot more, right, to cover the cost of the car to pay the IRS. You have to have enough money left to buy the car after paying your taxes, right? But it's not just cars, right? If your furnace goes, you have to replace that. If you need a new roof, right? Any major repairs, anything like that. So in your case, you may not, want to max it out. You might decide that doing the catch up on the Roth IRAs might make sense. You could do $8,000 a year there. So if you're married, Paul, you and your wife could do $16,000 a year in Roth IRAs, assuming you're within the income limits to build tax-free money. So if you have 5 years left, that's 16 times 5, $80,000. That goes, in with some growth. That gives you some tax-free money where now you can take some money out of that account if you need it for a lump sum purchase. So this is especially important when we think about creating reliable income streams in retirement. Remember, the goal isn't just to accumulate the largest possible nest egg. It's to create a sustainable, tax-efficient income strategy that will support your lifestyle throughout retirement. With proper tax diversification, you'll have more flexibility kind of to manage your income sources and potentially minimize your tax burden when you're no longer earning a salary. Another consideration is, what your income needs will actually be in retirement. Now, many financial professionals suggest that you'll need about 70-80% of your pre-retirement income, but that varies widely based on your planned lifestyle. If you expect to travel extensively or have expensive hobbies, you might need closer to 100% of your current income. So understanding this helps determine if maxing out a tax-deferred account makes sense for your specific situation. Let's also talk about sequence of return risk here, which is particularly relevant for income-focused retirement investors. Having some money in taxable accounts gives you more flexibility during market downturns. If the market drops significantly right after you retire, you could draw from these accounts rather than selling investments in your 401k at depressed prices. This strategy can help preserve your tax-deferred growth potential during market recoveries. I'd also consider whether you might benefit from a laddered bond strategy or other income-producing investments outside of your retirement accounts. These can provide predictable income streams without forcing you to tap into your tax-deferred accounts prematurely. Even setting aside enough in cash reserves to cover 1 to 2 years of expenses can give your investment portfolio breathing room during volatile markets. And don't forget about Social Security optimization strategies. Coordinating your retirement accounts withdrawals with your Social Security claiming strategy can significantly impact your overall retirement income picture and tax situation. Sometimes delaying Social Security to get those guaranteed 8% annual increases, if you're delaying beyond full retirement age, that is, can be more valuable than maxing out your 401k in those final working years, right? So you have to diversify according to taxes, right? Just like, Paul, your financial advisor probably says, diversify according to investments. We have to diversify according to taxes too, because the tax deferred, taxable, tax-free, right? The right mix gives you flexibility to generate retirement income in the most tax-efficient manner possible, which ultimately means more money in your pocket to enjoy your retirement years, Paul. So I hope that helps. Great question, Paul. Thanks so much. As always, if you would like to send in your question like Paul did, you can do so. You can email it to poollock@poollock.com. Moving on to our second question. This is from James. Great name, James. I love it. Most of my money is invested in my 401k, but I know you're not a fan of mutual funds. I'm 50 years old, and I plan to retire in about 15 years or so. Can you explain why you're not a fan of mutual funds? Perfect. James, let's dive into that one. Let's dive deeper into why mutual funds might not be the ideal choice as you approach retirement, especially when focusing on income generation, reduced risk, and reducing volatility in your investment strategy. First, let's address bond funds. Bonds are typically favored by retirees because they offer predictable interest payments and a fixed maturity date where you're assured to receive your principal back assuming the issuer remains solvent. However, when you invest in bond mutual funds, if you lose those insurances, right? The income from bond funds can fluctuate based on market conditions. There's no fixed maturity date for the fund itself. This introduces more uncertainty and risk compared to holding a diversified portfolio of individual bonds. Moving to stock funds, the primary issue lies in how they are managed. Most stock fund managers focus on achieving total return, which includes both capital appreciation and dividends. However, if you're in or nearing retirement, your priority often shifts towards generating income rather than purely seeking growth. Stock fund managers are often hesitant to prioritize dividend income over growth because their performance is benchmarked against an index. Now, during too much, separating yourself too much from the index performance can lead to periods of underperformance, risking the loss of investors' assets and potentially the manager's job. So as you accumulate more than, say, $250,000 in your retirement portfolio, which is a general threshold, diversifying into individual securities becomes more feasible and advantageous. By directly owning individual stocks and bonds, you can tailor your portfolio to focus more on income-producing assets while mitigating some of the risks associated with mutual funds. It's not about being against mutual funds per se, but rather recognizing that as your investment goals shift towards retirement income and stability, managing your portfolio with a more personalized approach can often yield better results. This approach allows you to align your investments more closely with your income needs and risk tolerance, providing greater control over your financial future. James, I hope this explanation kind of sheds light on why mutual funds might not be the optimal choice as you prepare for retirement. It's crucial to consider these factors and potentially explore alternatives that better suit your financial goals and circumstances. Thanks for your question. It's a topic that's essential for anyone planning their retirement, planning and adjusting their retirement investments. Hey, great questions today. And as always, if you would like to send in your question, you can do so. You can email it to poollock@poollock.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. See everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank,